Welcome everyone, welcome to Natixis and to this event from Natixis Research. Today is about macro, today is about markets. It's not going to be about sectors, about thematics that we used to have from time to time. These events will be, the next event on that will be on infrastructure, will be on tech and data and digital. We will have a big event to announce soon on that respect. But today's is about discussing the scenario, the macroeconomics, what is at stake for the next 6 months and the year forward, maybe a part of 2022 around that. We just published this Midyear outlook this morning. So if you have a chance to look at it, there is many things. So we are not going to cover everything today. We are going to stick to a couple of questions we think are very instrumental into market developments going forward. So if we miss something, please use as much as possible the Q&A that you have on your right bottom side, if I'm not wrong. The more questions you ask, the less talking you will get from us, so the better. So obviously use the Q&A, we'll be answering it at the end. So after a short 1 hour of discussion on our side, we can have this Q&A session with you. So the more questions, the better. So do not hesitate. So to pick up some questions for this session, we built on the surveys that we just had with you, our favorite clients. And many of you have sent some answers, and especially this question was very interesting to ask, and your answer were even more regarding the risk, the key risk going forward. And interestingly enough, the pandemic is now on third position, and the biggest risk from you is first thing first, the inflation, and then the tapering of central banks. Obviously the Fed, but the ECB, we will be discussing this topic. So we pick up this discussion. So today I have a mix of invitees. So here in Paris in the studio, and as well abroad. So in Paris we have Cyril Rognat. He's our chief for research, market research within Natixis. So head of the strategist of Natixis Research. I have Florent Pochon as well. Florent is our leading head of cross-asset strategy. So we will be discussing what could be a good portfolio allocation in the context that we are going to describe with my two senior economists joining us from abroad. So we have with us Joe Lavorgna. Joe Lavorgna is the chief economist for the Americas. He's used to be the former chief economist at the White House. So we are very glad to have Joe back within Natixis Research. And we'll have as well Dirk Schumacher, or head of the macroeconomist in chief economist for Europe. Dirk was the principal economist within the ECB, so we have a very good ECB and Fed watchers in this big subject that we have regarding the tapering on the central bank. Just maybe a few words on my side. As a very short introduction, basically what we say within Natixis Research is that the scenario, it's quite not a Goldilocks, but a very rosy scenario when it comes to the second part of 2021 and probably 2022. And it's a strong recovery after China. Last year was probably the main engine of growth, decelerating these days, but quite normally because China was alone in first in, first out of the COVID, and we see that China has been on a recovery path for the last 12 months, even more than that now. So China was alone, and then followed by the US, and then Europe is now catching up. So we'll be discussing that with Joe and Dirk just after. But maybe a few words on Asia and China, because we are not going to discuss that much unless you have some question on that. But in our view, that's not a black swan in a way. There is no big question regarding Asia. The big question we had recently was regarding the COVID in a way, because the region was very successful in isolating, tracking the COVID at first, but was very late into the vaccination programs. But what we see of late is a catching up. China is at more than 1 billion of its population vaccinated already. So we see some catching up, even though we have some question around maybe the quality of vaccine. Clearly, it's going to be there at some stage, and we see some catching up. A country like Thailand, for instance, we're talking about 300,000, 500,000 of vaccines a day. So it's going to be catch up. So we have no big question regarding Asia. On top of that, like I said, if you have the US, Europe, plus China all together at the same time, you have a very strong engine of growth worldwide. We're talking about 8.5 for the world trade that we expect this year, a very strong world trade. So obviously, in this context, this is very favorable to Asia and to emerging in general, but to Asia, which is mostly a good exporter country. I think of South Korea. I was mentioning Thailand, lots of tourism, 14% of GDP, but still a very big exporter of goods, Vietnam, and so on and so forth. So if you have a very strong recovery of world trade, it's going to be quite good for this country with a strong GDP growth. If you do not have a taper tantrum, and we will be discussing that, no big raise of rates, no big increase of the dollar, this is an environment quite favorable to the emerging world in our view. So in China, Asia in general, we don't see that of a big debate. We are going to be around 7%, 8% GDP growth, slowing down going forward. Much steeper slowdown going after that for China in our view, but at least for the rest of this outlook 2021, no big question about China. China will be around 7%, 8% GDP growth this year, so no big question. We don't think that the delta, we need to be delta edge, if I may say so, but still, in fact, all the variants, the delta story is obviously a big one, but I think we are totally on the same page as what you respond to the survey. This is a big risk, but maybe less of a risk. Why is that so? In our view, the supply chain are there. Think of Europe. Europe was late, but now Europe is the biggest producer of vaccine worldwide. 3 billion vaccine a year. Europe, I remember, is 500 million people. So you can export a lot of that, and that's already what the Europeans are doing with 400,000 million doses exported from Europe already. So it's going to continue. So it's going to be there. I'm not saying that we are done with the COVID, because obviously we cannot be done with the COVID if not the whole world is vaccinated. And if you look at Africa, you have only 1% of population vaccinated. So probably at some stage we will be back into junkie mode, where you need to have something through your nose and some shots in the arm at some stage for a third vaccine dose somewhere down the road. But what I'm trying to say is that we don't see that as a big risk of full lockdown in this context. The supply chain are there, the production capacity are there, the technology of mRNA is working, so we don't see much of a risk regarding the COVID. So I stop there on the COVID story to say that bottom line in our scenario, we are very much in a very strong recovery this year. The big question, and I will be starting with Joe Lavorgna on that, will be, is it going to be too strong of a recovery with some inflation pressures, and then the central bank have to remove the ball of punch and to remove the monetary accommodation, and then putting at risk all the valuation that we are going to discuss after that with Florent, for instance. Are they going to trigger some spike in interest rates that we can discuss after with Cyril? So I think that's a big question mark. Is it a transitory phenomenon, this inflation? Are the central bank are going to be beyond the curve or trying to catch up the curve and be acting quicker than the consensus thinks? That's probably the big question mark. So I suggest we start with Joe Lavorgna from the US, because that's probably where the big story is. We have seen that 5% inflation. We have seen a lot of discussion around this tapering coming or not from the Fed. Is it going to be as soon as this year, next year, and so on and so forth. So Joe, welcome. And my first question for Joe on the US. Do we need to fear inflation? Is it a long-lasting phenomenon, a change of regime within the US economy, where inflation, minimum wages, I would say imported prices are going to end up with CPI going higher in the US. Shall we fear inflation in the US? Joe, what's your take on that?
Joe, thank you, Jean-François,
okay,
for
thanks.
that. This is why I'd like to see everybody in person. Hopefully that'll happen soon enough. So on the inflation side, we've not been troubled by inflation, basically because of the nature of the downturn we had and the recovery we've had. So the economy in the U.S. looked pretty healthy in February of 2020. Unemployment was at 3.5%. That had adjusted interest rates on several occasions lower. Manufacturing was coming back. The equity market was at a record high. There was no real inflation pressure. Wages were rising at the lower end of the income spectrum. Economy looked good. Of course, COVID hits. The U.S. was shut for about 6 weeks. In those 6 weeks, GDP fell about 9%, or roughly 32% annualized. The economy started to reopen in May of last year. I, at the time, was a big advocate of what would be a V-shaped recovery, or actually, as I mentioned to the president, an I-shaped recovery. Basically, what we've had over the last 3 quarters, GDP has run at an annualized 14% rate. Given where we see growth in Q2, will be up on a year-over-year basis about 14% as well. So the economy's done well. You've gotten this huge increase in demand, and the increase in demand has happened much faster than supply could clearly come online, and that's why you've got these price pressures. This is why you've got these bottlenecks. But as productive capacity comes online because of restrictions abating, COVID restrictions slowing, you're going to see more production come, and that's what we've been seeing. So take lumber, for example. Lumber was booming because the housing market's improving. Home sales, construction, everything kind of at record highs. We're seeing rapid gains in home prices. And yet in the past month or so, lumber's down about 40% because production's come online, because these mills can start producing. And we're going to see more and more of that. Moreover, because demand has been so strong, we know, Jean-François, that we're pulling forward from future activity. So in the goods sector, we're about 4 percentage points above the long-term trend in terms of goods share of GDP. We're going to go back to trend, probably below trend. So you're likely, to my mind, losing anywhere from at least 4, not upwards, maybe 5, 6% of GDP, just from what will amount to be a consumption goods drag. So this year growth is very strong. It's going to be up. You mentioned China at 7 or 8%. That's basically where we see the U.S. Next year will be much slower. History would suggest that it will be half of whatever this year's growth rate is. However, given all the government stimulus we've had and the fact that it's been so front-loaded on the consumer side, the pullback should be more significant than history. In a world where more supply is coming online, GDP is down, decelerating, that to me is not really an inflation story too much. I look at commodity prices moderate a bit. I don't see labor pressures really accelerating much. The dollar is well contained. Inflation expectations are well contained. So in this sort of environment, this is pretty constructive. But the markets have been agreeing with us as we've seen those market-based inflation expectations move a good deal lower over the past couple of months. I'll leave it there.
And Joe, on this matter, two remarks and two questions on my side to follow up. You say you don't see any pressure. Are you not worried about what's going on? A lot of talks around the minimum wages increases within McDonald's or Amazon. Is it something of a kind of a spillover effect that you can expect in the US or not?
I'm not worried about it, Jean-François, for 2 reasons. One, I remember when we increased the minimum wage at the state level back about 7 or 8 years ago, the majority of states increased their minimum wages, and there was really no inflation impact whatsoever. At this point, if the federal government was to institute a minimum wage, it wouldn't. I don't believe it would have as big of an effect as what we've already done in many states to begin with. More importantly, we're finding isolated spots of wage pressures and certain companies having to pay up for lower skilled workers. But broadly speaking, I would argue the productivity numbers have been understated, which means that wages can rise if productivity is increasing. But to this point, with that rising productivity and record high margins, which we see from various companies reporting in the S&P, companies are able to maintain those margins, are able to maintain those profits. So what you're referring to me, is more isolated. I don't look at it as being a problem whatsoever. And in fact, if we run out of labor at the lower end, unfortunately, what it probably means is more automation, more efficiency, and those jobs, unfortunately, won't ever exist again.
Thank you, Joe. My second question was, you mentioned a bit of a housing market improving. Is it not closer to a bubble when we look at the latest prices in the US? Are you not concerned by these numbers, eye-popping number with house prices and of late in the US? Is it not a bubble about to burst?
No, it's not a bubble about to burst. Housing certainly is very expensive because rates are low. The economy is booming. There's been now a shift from major urban areas to suburban or outskirts of city areas as people have the ability now to adopt a hybrid model. Housing inventories are essentially, Jean-François, close to an all-time record low. So again, this is one of those stories where demand is outstripping supply. High prices will induce new entrants into the market. You see as construction increases over time, you're going to see more supply. It's going to obviate some of those price pressures. So no, I don't see it being a bubble. Lending standards have been tight. There's not been a lot of leverage in the system. So this is completely different than what we saw back in the 2000s. So no, I see a very expensive housing market, but not a bubble.
Okay, and as a good transition to my second question, which was around the Federal Reserve policy and the tapering, which is the name of the game probably of the many months to come. Do you think in this context of, well, like you said, not that tense housing market, but would it be possible for the Fed to cut on its MBS buying without triggering something of a response from the house prices?
The transparency is a double-edged sword. Sometimes, you want to do things and not necessarily know that you're doing them because you think it's in maybe the better interest of the greater good. And in this case, the Fed wants the economy to move back strongly. Chair Powell has talked about a broad-based and inclusive decline in the unemployment rate as a factor behind their decision to taper and eventually tighten. And to me, the cutback on the MBS would potentially lead to market rates going higher, but certainly the Fed would take criticism in slowing housing. And so if I was at the Fed, I'd be telling them, look, just leave well enough alone. Let's get the economy moving. We know growth is going to slow next year. Let's gauge the extent of that slowdown before we decide to taper any asset purchases. And again, we're talking about fiscal policy at some point as well. Who is going to be the buyer of these long duration assets, whether it's treasuries or mortgages, if the government continues to run historically unprecedented deficits? Last year, we had a deficit of 15% of GDP. This year, we're going to run a deficit of about 17% of GDP. You overlay that with a current account that's probably going to be somewhere around 5 or 6. You're talking twin deficits up near 22, 23% of GDP, which is staggering. I'm not sure, Jean-François, the Fed can dial back their MBA purchases or their treasury purchases as quickly as people think, especially if we're going to get more fiscal stimulus coming down the pike.
Thank you, Joe. But I have to remind you that now you are Natixis. You are not anymore with the Federal Reserve. You used to be, I know, because when we hear what the Fed is saying, because now we are saying, they used to say they are not even thinking of the tapering. Now they're saying they are talking the tapering. What's your take on this? How is going to play out this tapering story by the Fed? You mentioned it a little bit, but what's your view on this tapering story by the Fed?
This is when I hear these sort of words, Jean-François, it does feel like an out-of-body experience or some sort of comedy sketch. I'd be remiss in not highlighting the Natixis work that suggests that the Fed will be tapering sometime early Q2 of next year, with the Fed potentially announcing the tapering back from whole meeting next month. Those, to me, are reasonable forecasts, but it will basically be evident upon how the economy performs and also how asset markets perform. We've had, I believe, now 5 quarters in a row in which equity prices have risen. Household net worth as a share of income is at a record high. Stock market capitalization as a share of GDP is at a record high. And I do worry, as you know, that the Fed might have missed its window in terms of making it easy to taper and potentially eventually laying the groundwork for tightening. Because if the Fed can't taper when the U.S. economy is running at a 7 or 8% rate and unemployment has fallen from almost 15% last April of 2020, to under 6% and likely under 5% this year, which is really remarkable. in my opinion, be difficult to taper in a way that's not destabilizing. Maybe the way around it is you just keep talking about it and saying you're talking about it, but you're not really talking about it, so the market becomes comfortable with it. But again, at some point, the Fed would have to step away from the market and somebody has to come in and buy. We've seen much less foreign investor participation in the U.S. Treasury market. And therefore, I do worry about a wobble. I do worry about a taper tantrum, a growth scare at a time when not only the housing market, but as I alluded to, asset markets are very, very expensive. It's going to be tough for the Fed.
So, thank you, Joe. Maybe just as a transition, because I guess the Fed policy will be depending on the broader view of the policy mix. What do you expect from the Biden administration in terms of this infrastructure plan? Because, like you said, within Natixis, we have this view that we'll get 7.1% GDP growth this year, and probably half of that only next year. So, like Joe said, it's maybe a missed opportunity to taper from the Fed. But what about federal policy? Can you be reasonably optimistic that we have something cooking on this infrastructure plan, the family plan? What's your view on this, Joe?
Sure. So in the Biden budget for this year, this fiscal year, it's $6 trillion of spending, $2 trillion. I'm going to round to the nearest whole number, the nearest trillion. We had $2 trillion of COVID-related spending back in March. That was done through budget reconciliation, which means that you only need 51 votes for it to pass. That's what happened. And then shortly thereafter, the administration put forward two plans, an infrastructure plan at $2 trillion and a social welfare family plan at another $2 trillion. There was agreement among a broad set of politicians last week on an infrastructure plan. It was not $2 trillion, it was closer to $1 trillion. That's a plan that I thought was more likely and what was feasible. However, the president at the time mentioned that he would not sign that bill unless there was also a family welfare plan alongside infrastructure. In other words, they had to be done in tandem at the same time. Those comments were walked back a couple of days later, but Nancy Pelosi just today, or it might have been last evening, said that no, we have to have those two plans together. And that's going to make it very difficult, in my opinion, to pass stimulus. So I would put the odds of a bill at this point below 50%. Moreover, Jean-François, we still have to pass a debt ceiling increase by July 31st. If not, the Treasury, I'm guessing, will have to do these extraordinary actions that they've done in the past. We also have to pass a appropriation bill to fund the government, which begins October 1. And just checking my notes very briefly, the Senate is back. Here's the Senate's in the week of July 12th. Then they're back only 1 week in August. So they're basically around 2 weeks between now and Labor Day. The House isn't back until July 19th. They're here July 19th and July 26th. But then they're not back until September 13th. So basically, the U.S. Congress is on summer holiday for much of the next 2 months. It's going to be very interesting how this gets done. But to me, again, the probability of an infrastructure bill, unfortunately, because it's got bipartisan support, it may now have gone well below 50%. Which, by the way, Jean-François, if you don't get that stimulus, that may be another reason why perhaps, just perhaps, the Fed decides it doesn't want to taper maybe as soon as it wants. It will look at less government spending, being less stimulative for the broader economy.
Okay, thank you very much for these comments, Joe. So as a key takeaway I will take from what Joe just said. As you see, we are quite optimistic on the GDP growth in the US, 7.1%. Next year, probably half of it. The chances to get an infrastructure plan are probably remote than what the consensus is. So in this context, for the Fed, we are expecting a tapering much smoother and much slower in a way than probably the consensus is. You have a 3/4 of a rate hike in 2023. We are much more cautious on that because inflation will be going down, GDP growth will be going down, and then the midterm elections are coming, and so on and so forth. So, in our view, the US scenario is probably less of a quick tapering than maybe a slower tapering in our view. So maybe switching to Europe, the other side of the Atlantic with Dirk Schumacher. Thank you very much, Joe, once again. We keep you with us for the question after. Please do not hesitate to use your Q&A possibilities on your screen that we can answer your question, if any, at the end of the presentation. So Dirk, we see that the US is booming this year. It has been starting out of the COVID much quicker than Europe. Can we say that at the end of the day, now it's a little bit Europe's turn in terms of GDP growth. Is Europe starting to catching up?
Yeah, Europe seems to be lagging always, but eventually it will catch up, and I think the time is now. The reason Europe was lagging is that we were still fighting with a second or third wave, whichever way you count, and that the vaccination process in Europe was delayed relative to the UK or the US. But now the numbers in terms of vaccination look very strong. We have caught up with the US actually in terms of at least being vaccinated for first time. And if you look at the latest data throughout Q2, they are consistent with a strong rebound in activity. So at the beginning of the year, there was still a small contraction of growth in Europe. And now we're seeing, as the economy is opening up again, that numbers look pretty strong. And it's also true that the fundamental picture looks quite healthy in the sense that, well, that's similar to the US. Households are sitting on huge amounts of savings. Some of that will be spent, of course, not all, but some that will provide additional impetus. We see that investment spending is picking up. That's what the early indicators on that front are telling us. The corporate debt level has increased significantly, but if you look at the details, that's not really a problem in a sense that most of that additional leverage is just cash sitting on the balance sheet of corporates. So overall, the outlook fundamentally looks pretty solid for Europe, and there's quite a bit of potential for catch-up. Now, you mentioned the Delta variant, and that is, of course, the risk in the background, and I hesitate to be too optimistic given that we've seen in the past, again, disappointments. But the fact that vaccinations are progressing, the fact that there's no evidence that vaccines are not working against the Delta variant, I would still think that for the remainder of the year, the growth outlook for Europe looks pretty solid. And that's the good news, if you will.
Thank you, Dirk. We talked that with the US, and we hear a lot about this comparison between the US and Europe in terms of budgetary plan. And what Joe was saying was that watch out, and we have only a couple of weeks to have this window open for additional plan from the Biden administration. So it's going to be challenging, and we need after that to discuss in the budget, the debt ceiling, and so on and so forth. What about Europe? We have seen the first steps of this kind of proxy of a federal budget. How do we compare with the US when we look at the Renew EU plan? Is it that bad compared to the US? Is it the first step towards federalism in Europe?
Well, the fiscal response is not as aggressive than it is in the US. One has to keep in mind, though, that the fiscal automatic stabilizers in Europe are bigger to begin with. So the US had to do a lot of fiscal action because, say, the social security system isn't as generous, and a couple of structural reasons why the need for fiscal response in Europe, all else equal, is smaller than in the US. But on top of that, it's still true that the US does a lot more. Now, the Next Generation EU fund is indeed a welcome help for growth, though most of that impact will be felt only next year. So on our calculations, it could add something like 1 or 1.5% of growth next year on top of national programs. It's a bit difficult to say ex ante because there's quite a bit of uncertainty still how the money exactly is going to be spent and when. But nonetheless, it's clearly a welcome aid in terms of cyclical support next year. Now, the more structural and at least as interesting question is that the beginning or a significant step towards fiscal integration in Europe? And here I'm a bit torn. Of course, the fact that governments agreed that the European Union is allowed to issue debt in such an amount, it's more than 750 billion, that is significant. It's not all jointly and several guaranteed, but nonetheless, it's a major step. At the same time, it's a one-off. That's what at least the official documentation very clearly says. It's related to the pandemic and fighting the effects of the pandemic on the weaker economies and so on and so forth. It's meant as a kickstarter to the recovery and also should address some of the structural issues. Now, there are several governments who say, yes, it's a one-off, but of course, it's the template for further steps. And the political hurdle, though, in particular among Northern European countries for making that a kind of a permanent feature of the institutional framework within Europe, I think is high. The outcome of the German election, I guess, will shed some light on the probabilities or how likely it is that we see more towards that direction. But again, I think the hurdle for making that permanent is high. It's nevertheless an first important step, as debt issuance on the level of the European Union in that size has never happened before.
And talking of which, as you just mentioned it, I was about to ask you the question, Dirk, regarding the German election. We here in France talk a lot about the presidential election coming in mid 2022, but probably even as much important are the German election. The way we look at it is more to say that probably whatever is the alternative to Merkel, if we look at on both sides of the political spectrum, we tend to think that it's going to be at least as much pro-European, if not more, than was Angela Merkel. What is at stake during this German election regarding vis-à-vis the federalism slow start that we see in Europe? Do you think it's going to be instrumental, this election?
I would not expect dramatic changes. Usually German politics doesn't do dramatic. I guess the French presidential election
French,
in that respect could be more interesting. Most likely, the conservatives, the CDU, CSU, will be part of the government, which also means that any further steps in terms of fiscal integration are going to be incremental, are going to be gradual. That's just the way these things operate. It's only if you had a left-leaning ruling coalition, which I wouldn't rule out, but given the latest polls, it looks very uncertain or unlikely, that you have the Greens, the Social Democrats, and the Left Party. They would probably dare to do bigger steps in terms of fiscal integration. But again, that's rather unlikely. As long as the conservatives are part of the ruling coalition and or the liberals, there are clear limits. Moreover, one should keep in mind there's always the German Constitutional Court in the background. And I know that non-Germans are fed up with the German Constitutional Court and if you will, all the problems it creates, but that is still a binding constraint for whatever government will have after the September election. And the court has put down its foot and said there are clearly limits in terms of fiscal integration. And of course, you can overcome them, but for that, you would need to change the constitution. And that means a 2/3 majority in both chambers of parliament. So that is a high hurdle. So I would not get my hopes too high on how much further fiscal integration will come after the September election. It's going to be incremental. It's going to be dependent on lots of other things. And as you saw during the pandemic, if the situation is ripe or calls for bold action, then that come. But I guess that's as much as we get for the time being. And if I may add, we should consolidate the wins, so to speak. I mean, there's this notion that we have to constantly push forward in terms of integration. You can do too much to it. You create a sense, at least in some quarters, that you're overdoing it, and can debate to what extent Brexit is as a factor or as a consequence of that. But I would say we've reached quite a bit. Let's just consolidate, wait and see. Make sure it actually works, make sure that the Next Generation EU plan is implemented in a way such that you can, in a couple of years' time, go back and say, look, it was really worth doing it. The money was spent wisely. Look, Italy has spent the money in a way it was supposed to spend it. And then we can see what happens after that. But this kind of breathless, let's do more and more is, I think, not helpful.
And talking about doing more, what could be a potential outcome? And we talked about that at length with the US regarding inflation. My question will be on shall we fear inflation in Europe? Because in a way, and like you said, it was a closed economy for COVID reason, and we are reopening the economy, but without much of impact. And it's not a war. There's no destruction of production capacities. You mentioned that, Dirk, that the European economy, if you take France, for instance, it's a big share of the economy is the services, and we were closed for the services. If we're reopening up that, and for France, you think it's close to 50% of GDP. We are talking about 160 billion additional saving for France. I think you made a publication lately, Dirk, saying it's $500 billion for Eurozone itself. So if we're reopening up economies, services on top of goods, which we are doing very well, and we have seen that the trade worldwide was doing very well, Shall we fear inflation in Europe a bit like we have seen in the US of late? I know there is lots of basis effect, but beyond that, shall we have this kind of overeating economy in Europe leading to inflation?
I mean, if Joe's relaxed about inflation, I see no reason why we should not be relaxed. I mean, the US is cyclically more advanced.
You're German.
All the arguments that apply to the US, I think apply here even more. Now, it's true that headline inflation went up quite a bit, but that's due to energy prices. If you look at core inflation, it's astonishingly low in the euro area. And we just had the June numbers. Actually, they were, compared to what I thought at the beginning of the year, quite a bit lower. Now, there is inflationary pressure on the producer level building up. We know that. We see that. That's what the indicators are telling us. We know that as the service sector is opening up, there will be some pent-up demand that will lead hotels, restaurants to hike prices. We've seen that in other areas in the service sector last year when they opened up again after lockdown. So yes, I would expect inflation to still develop more dynamically going forward, not just headline, but also core inflation. That would be consistent with some of these early indicators. At the same time, it's hard to see how that spins out of control, how this creates the kind of inflation spiral that feeds on itself. The output gap, even if you're very generous with the growth forecast, still remains high. There's a lot of underutilized resources in the economy. The labor market doesn't look as bad as you could have expected after that recession, but there's clearly still a lot of unemployment in the system. So I find it hard to make the case that Europe, even in the most optimistic scenarios, is heading towards overheating or creation of that kind of inflation that should worry the ECB or policymakers. So to answer your question, no, I don't think we should be worried.
And maybe to add up a last question on your side, it makes me think of as well the ECB, because Joe said, well, okay, the Fed is probably relaxed regarding inflation, temporary effect when we look at Jerome Powell speeches. When it comes to ECB, we have the impression, is it something you share as an impression, that the ECB is going to move toward, in its strategic review, towards some kind of average inflation as well? Meaning that in a way they are less concerned about inflation, let's put it this way, and more about green transition, more about being more inclusive. And you were mentioning these numbers of unemployed in Europe. Christine Lagarde mentioned a 15% bigger unemployment rate for Europe. How do you see the strategic review of the ECB? Do you think the ECB is going to be moving toward average inflation, meaning more relaxed about inflation going forward?
Well, average inflation targeting is appealing in theory. I just think, and I guess that's also my reading, what's happening is it's difficult to implement in practice, and even more so in the euro area context. Now, if you look at the Fed, it's a very kind of one-sided average inflation targeting, and nobody, I mean, Joe might know, but what do they exactly mean? We'll find out over time. And the Fed, if you will, has it easier than the ECB, given the multiple country setup in the euro area. So doing that step in Europe is a lot more complicated. Plus, you have certainly some segments of the general public who would view that so that the ECB lets inflation overshoot for some time as, well, showing what the ECB is really about. So there are a lot of people who are kind of skeptical about the ECB and what it really wants, unjustified in my view, but announcing average inflation targeting would only stoke that fears that the ECB actually wants to create a lot of inflation, though creating inflation would be needed. So I don't think they dare going down that route. It's too complicated to implement, and you don't know how the public, or in some countries at least, will react. And an alternative, obviously, would be to announce a higher inflation target. So if you're worried about, say, the lower bound and how to address these problems, that you can't cut interest rate enough if need be, would be to announce a higher inflation target, let's say 3%. But of course, there's also difficult, for the reasons I mentioned with respect to credibility, but also how do you get there? And if you announce an aggressive inflation targeting, but you're not able to fulfill on that, well, that undermines your credibility as well. So what I would expect is something very simple. You get rid of this close to but below 2%, which is the current framing of the inflation target, which is a bit opaque. It's not exactly clear what's meant. Just say 2% symmetrically, i.e. we, the ECB, react to overshooting, undershooting in the same way. That takes away some of the uncertainty and I guess is helpful. Anything more aggressive, I find hard to believe that they are going there.
Thank you, Dirk. So answer to that in September with the some communication probably on this new strategic review of the ECB. Thank you very much, Dirk. Maybe I move to Cyril Rognal just to follow up on the ECB, maybe to look at what could be the ECB technical and practical response to this environment of we just described with Joe and Dirk. What could be doing the ECB in the next months, Cyril, and what could be the impact on the markets?
Well, maybe to start with, something important to say is that as long as the ECB is expecting inflation, long-term inflation, to be around, let's say, something between 1.2 to 1.4% in 2023, it means that the ECB will have to keep a very accommodative stance. However, it doesn't necessarily mean that the ECB will be more supportive next year than it has been this year. If we look at the figure, and notably to this PPP program, we know that the ECB more or less will end the year with a remaining envelope around 350 billion euros. And with only 350 billion euros left, of course, we have to wonder how the market will be absorbing the huge growth supply we'll have next year, because in our estimations, we see gross supply around 1.3 trillion, so roughly, in fact, the same kind of amount we had this year. In the end, and I think we've been looking at markets and, well, the Fed has been the elephant in the room since the beginning of the year. But in the end, it's very likely the ECB will start reducing its bond purchases before the Fed. And you were asking about the potential market impacts. We do believe that in this kind of context, it's likely investors will be wanting to front-run somewhat the ECB's future decisions. So with a less supportive ECB ahead, it's likely investors will want higher interest rates as well. So reason why we would tend to be bearish on the euro market as well on the US market, but when it comes to the euro market, definitely bearish.
So in a way you are saying that maybe the tapering that we are talking a lot is from the Fed, but actually the tapering from the ECB could happen a little bit quicker than the Fed?
Yeah, well, it's going to be technical. It's not real tapering. It's the same kind of situation we've seen in England with the BOE, because we know that there's a limit on this PPP. But for sure, I think it's going to be interesting because everybody will want to assess the potential impact and how much investors will be willing to absorb in terms of issuing amounts.
And what about the other risks that we need to look forward in Europe on this second part of 2021?
Well, what is really tricky is that alongside this recalibration of the ECB's purchasing program we are mentioning, we will have some kind of revival, in fact, maybe potential revival, let's be optimistic, of idiosyncratic risk in Europe. With notably two elections, of course, Dirk has been mentioning the German elections, and on the long run, I think it's going to be very interesting because budgetary discipline is still key. It's still key for countries such as Italy. If tomorrow, let's say Armin Laschet is a German chancellor, and we know that he has been asking for all European countries to respect the 3% deficit rule, then for Italy, countries such as Italy, it could be, of course, a risk. But market-wise, of course, when it comes to elephants in the room, France is probably leading the herd. And of course, French elections, French presidentials will have in April next year, will be key. And it's very likely that investors will be willing to somewhat front-run, of course, this specific.
Can you have, we think, kind of episode very similar to what we had in the first quarter of 2017 or end of 2016, where huge, remember, a big widening of OAT-Bund spread due to the French presidential election?
Really difficult to say at the time being. We have something in common, is that we have a lot of uncertainties, of course, ahead of this ballot. A lot of candidates are unknown, which is quite important. Then, what has been positive, let's say, on the French side is that you were mentioning the sell-off we've seen in 2017, and what is important to say is that the market positioning, notably of foreign investors, which are more likely, in fact, to sell OATs, this positioning is way smaller than it used to be, which is positive for OATs, of course. Then, what is also very important to say is that we know that the race is going to be way tighter next year than it used to be in 2017, not only when we look at the polls. So for sure, this tighter race by itself would probably justify at least a widening of spreads.
So in terms of target, what does it mean in terms of the level of Bund, OAT Bund, and even BTP Bund? You mentioned Italy before. What's our forecast for the end of this year?
Well, when it comes to the 10-year OAT Bund spreads, we would expect a widening towards 45 BPs by the end of the year, a spike around 65 BPs, so a bit lower than what we see in 2017, and of course some contagion. Around France, and so all the soft core area should be probably should suffer the spillover effects of these French elections, but probably some sell-off as well, or underperformance against bonds on BTPs, maybe on Spanish bonds as well, but less so. So contagion, widening of BTPs, and our target would be 150 BPs. All of this in a context in which long-term interest rate will be increasing in Europe. And in this regard, we do expect a 0% level for the 10-year Bund by the end of the year.
Okay, thank you, Cyril. So maybe a last question, quick question on my side. Can we fear that the next, the Renew EU plan, which is starting to issue a lot, and maybe you have some figures to share in terms of supply, that this is a new issuer coming into Europe, a very AAA, super liquid. Could it be a threat to OATs, for instance, to Bund, or even to treasuries at some stage to I will say, capture part of the global saving, which is at the moment refinancing treasuries, going into the Bund or the OAT? Is Europe can be taking a bit of a market share of investor into liquid asset, and then triggering a bit of a widening of spread in this regard?
For sure, it's going to take a share, at least in the investors' portfolio. We know that the EU will be issuing 80 billion euros this year. Next year is going to be even bigger. We're talking about 150 billion euros, out of which we know that the Eurosystem will be buying probably a weaker chunk of bonds, because as I was mentioning, the ECB, in the meantime, will be recalibrating its BPP. So we do believe that this very big program is likely somewhat to pollute or to have spillover effects on the soft core area, and a potential underperformance of OATs, over supranationals, and maybe cover bond as well. This is something we've already seen in the market as of late.
Thank you, Cyril. And en passant, we can say that if part of the global saving, especially from German investors, stops going refinancing the treasuries market in the US and stay within Europe, financing Europe with AAA, nice liquid debt, which is building up, maybe it can have some spillover effect, not only on spread, but maybe on the dollar and to US spread at some stage if, as you know, Europeans are the top 3 buyers of treasury. That used to be first of late. So So that could be having an impact as well on the euro dollar. So thank you very much, Cyril. I think we move to the last but not least topic of today. In all this context, which is okay, strong growth, but tapering is coming. Central banks are going to step in at some stage. We are not going to get this ball of punch forever, so it's going to be removed. So how do you see? What do we need to look at when we look at our investment and asset allocation, Florent?
Well, thank you, Jean-François. Well, basically, I think we need to have a view or try to get a view on what the market will apprehend these three factors we'll be talking at length now, which is growth, inflation, and central banks. So I think clearly these three factors will remain, the most important in the next quarter and in the second half of the year. Basically, what I think is that the hierarchy between these three factors will change in the next months. We had during the first half of the year, the main factors were growth and inflation, and I think we're going to shift still with growth, but more towards central banks. So this is really important. But that said, I think it's going to be a bit more tough, probably a bit more sporty, let's say, for asset allocators. Why? Because clearly the market now is in the mood, is a bit navigating through these three factors, and somehow these three factors are in a transition mode. So the market will have to look through that. If we look with inflation, for instance, we've been talking about the view we have that inflation will be somehow transitory. Well, basically, the reflation trend has been a huge trade at the beginning of the year, but clearly, probably it has been a bit overdone, given the views. We've been seeing, massive, let's say, bear feet steepening at the beginning of the first quarter. We've been seeing inflation break-evens climbing very significantly until mid-May, and we've been seeing a lot of strong positioning in commodities, and also a lot of flows toward linkers. Again, we've seen if you look at ETF linkers, for instance, the volume on inflows in ETF linkers were 3 times largest than the inflows into treasuries linkers, while the IUM is twice as low. So we've got a huge inflows in ETF linkers, and we think this is overdone if we are right. So what it means is that the inflation factors should fade away if we're right, and that we probably will not see the pricing of the market remaining stable or continue to decrease. On the other hand, growth we believe is going to be key, and we've seen a great momentum on macroeconomic factors. We've discussed it at length with Joe and Dirk, and on the microeconomic level too, we've seen many revisions. We've seen revisions in EPS earnings that have been accelerating this over the last quarters, and which had as an effect a very low risk perception and a very bullish environment. And lastly, the central bank, as I mentioned, and we just discussed with Cyril and Joe and Dirk, I think that things have been changing. Why? Because clearly the message that the central banks will want to normalize somehow, but still will not want to take away the bunch, as you said. So they want to stop easing, but they will not stop easy monetary policy. So that's why all the three factors are somehow in transition, and I think the market have been really looking through that and trying to look at each factors over the last few months without really deciding. So we've seen 1 month it was more, let's say, Goldilocks style with a bull bonds and go for growth, and the months before it was more value strategy. So the market is really hesitating. So my view will be really. And we'll discuss after, follow the momentum where it is, the macro momentum, expect the inflation story to decrease somehow, and have a close eyes on central banks, of course, as we discussed.
Maybe just before moving to the next question, please do not hesitate to use the Q&A possibilities that you have on your screen on the right-hand side, the right bottom side, I guess. If you have any Q&A, we will be following with this session just after. I forgot to remember that. My next question for you, Florent, is regarding earnings. You mentioned Europe versus US. Maybe you said we tend to want to play Europe against the US because of valuation, because of this catching up that Dirk was mentioning regarding the macro picture. What are the earnings expectations, Europe versus US? Is it?
Well, what really think right now is that you have to continue to play the recovery. So that's what I said. 6 months ago we said this is a sweet spot for equities. Well, the sweet spot is getting a little bit less sweet, let's say, because we said there will be uncertainties about growth and a bit more uncertainty about central banks. But that said, I do believe that we have to pick where the momentum will be the strongest, and we've seen that again, the recovery in terms of earnings has been much stronger in the US. Overall, the recovery rate in the US EPS earnings for 2021 was 110. So earnings of 2021 was 10% above the pre-pandemic levels. In Europe, it's still 10% below. If you look at the same in terms of sectors, you have only 3 sectors in Europe, in US, where you have a lower EPS than pre-pandemic, whereas 9 out of 11 sectors in Europe are still well below.
So Europe is cheap.
Europe is cheap, and recovery in earnings will continue to accelerate in the next few months. That's why you have to go there, and that's why we are bullish on cyclicals, European and equities, on European equities and on cyclicals, on European cyclicals versus US cyclicals. Other areas we like in equities will be some emergings, because again here we see some discrepancy between price recovery and EPS recovery, and we think that notably in LATAM and in emerging Europe, you've seen some place where you should have a catch up in price in equities.
Despite the COVID and the variants in LATAM?
Well, we've seen huge rally over the last few months in India, Brazil. I think the market is really looking forward now.
Beyond the pandemic.
Yeah, be it right or wrong, cynical or not, it's still looking forward and expects that things will improve. So yes, we are definitely bullish on cyclical assets, bullish on European stocks, at least for the next few months, because the catch-up will continue, and we continue also to like cyclical commodities because they are the same view. We think that there are still some value there, especially in metals, but. That said, I think that the key, again, I said that the 3 factors will be a bit more blurry because they are in transition. This means that we'll have to be more tactical, I think. And probably there will be late in the year a transition where we will have to move away from cyclicals and more to quality and to growth stocks. So I think this is going to be phase number 2, probably at the end of the year. And this also makes me believe that we should stay invested in somehow in tech, because basically the market will be hovering between higher growth, higher momentum in Europe, and between potentially the slowdown that Joe was evoking for 2022. So if there is a slowdown, well, there'll probably be less pressure on bonds, and we'll go to Goldilocks style, where you have to play carry and you have to play quality and growth sectors. So a bit more sporty asset allocation, still bullish, but again, be more tactical and really look at the Fed and look at the central banks and follow the momentum what it is.
So basically, still a risk-on environment you describe. Maybe one comment on my side is that you mentioned commodity, and we like emerging and commodity-led emerging. On the document that's been published on this media outlook, you will see that we are discussing this super cycle. We are discussing the possibility of having oil prices going to $100. We don't buy into this. My geologist, Joel Hancock, my oil analyst, is saying one thing, is that you have a lot of spare capacity. I'm not following what the OPEC is saying at the moment, but clearly we have some spare capacity from the OPEC plus Russia, definitely. So we can expect OPEC to provide some more supply going forward, and think of Iran as well, maybe coming back with a 1.52 billion barrel a day potentially. So clearly we don't buy into this super cycle commodities for oil. Having said that, obviously, if the whole world is trying to do catching up with energy transition to the green transition, obviously some metals, some commodities linked to energy transition will be clearly there. So maybe I just mentioned oil, which is probably one of the risks, but this is why as well we think inflation is not going to be going much higher going forward, because we think energy prices are going to stay put, so the basis effect is going to play down on the reverse. So this is one risk I don't think is there. What are the other risks in your view, Florent, in your asset allocation?
Well, I think Joe mentioned it. Is the way the market will, the Fed will communicate on tapering, and the way the market will buy this communication is going to be very tricky, I think. So we've been writing a couple of reports on why should we fear some kind of correction due to mini, let's say, taper tantrum. Why? Because if you look at real rates, they seem a bit low. If you try to look at fundamental levels, you will find that they are pretty low. So you may explain that if you compare that to macro fundamentals. You may also see, of course, some liquidity premium because the Fed is holding now more than 20% of the tips in its balance sheet. And so if you look at fundamentals or liquidity, you now have the same liquidity premium that you had before 2013. So it's interesting. You have series in the Fed website where you can see it's literally the same level as before the Fed the taper tantrum in 2013. So that means that there's some vulnerability for real rates, at least to correct, at least for 50 or 75 basis points upwards, if there is some kind of fear by the market that we may have tantrum. So this means that, of course, if you put that in front of the fact that valuations of equity have been really high, you may have, as Joe mentioned, some really turmoil in the markets. That said, again, I think that this is really some tail risk. You may have some correction. Remember, for instance, 2013, the correction in the S&P was somehow limited. It was 6% on drawdown. So, and the stocks came recovered fairly quickly. So, given that, plus the fact that I think the Fed learned its lessons and he wants clearly to avoid a correction of more than 100 basis points, then this for us could be a risk and could trigger some kind of short-term correction, but not a bear market, clearly.
Thank you. And maybe a last question on my side for you, Florent. We hear that the central banks, in our view, are going to be probably more accommodative and that we don't buy into this acceleration of tapering and the ECB even led than the Fed. They have to taper, but again, the inflation being at bay around 2%. No reason to panic and to remove the ball of punch once again. Do you think that if we still have a little bit of tapering, it's going to be the end of this low vol regime that we are benefiting from? Or is it going to be a little bit more volatile in this context? What do you say?
I guess it probably depends the way it tapers, because you have these two theories right now. Is the new reaction function of the Fed means it will react more lately but more strongly, or will we have a taper a bit sooner but less aggressive? So I think this is going to be probably not the same impact on the market. If you have more aggressive move, it's going to move the volatility upwards probably more let's say powerfully. But now, if we look at the volatility, somehow, if we look at our metric and our fair value models, we see we are pretty fairly valued right now, fair valued. So we think that the reason why the vol would be a bit higher would be that there'd be a bit less liquidity, a bit more uncertainty about earnings, which may happen basically during the end of the year, and that there's a bit less, let's say, liquidity in the market. But that said, given the fact that we expect some dovish, let's say, still easy monetary condition, and the fact that the Fed will be willing to keep this easy monetary condition, we think the volatility on the upside will be really capped. That said, again, what's interesting in this chart is that there are still some nice opportunities. So currently you have a lot of skew in the market, so you can get protection, and you can take advantage of this kind of skew to get cheap protection on the equity market. So this is what we advise for those who wants to go to the beach with a bit of peace in mind.
What are your, okay, thank you very much, Florent. What's your key takeaway, globally on this asset allocation?
So we remain bullish on cyclicals, overweight equities versus bonds, because no matter the expected returns for bonds will be really low. For credits, valuations are tight. So equities is still the place to be for second half of the year. The style will depend on the timing, on the recovery, and on momentum on the macro side and on the Fed communications. but we're still bullish on cyclicals.
Okay, so risk on environment. So thank you very much, Cyril and Florent. We may now have a few questions, if any. Do not hesitate once again to give us your question. If I summarize our view within Natixis research going forward for the rest of 2021, this is a very supportive environment. You see, it's not Goldilocks, but in our view, the central scenario again, there are many unknown known and unknown. But clearly, our central scenario is quite bullish in terms of macro picture. Once again, 7% GDP growth in the US, 4.4% in Europe, close to 8% in China. This is a very strong environment. World trade 8.5%. So the whole world is going to be at full speed at the moment. Even though China is decelerating, it's still a very supportive environment going into the next 6 months and probably part of 2022. Dirk mentioned it. The output gap is far from being closed, especially in Europe. Even the US, we are back to 2019 levels. We will be above this level probably in the US next year, but we are far from it in the rest of the world. Talking about Europe, but think of emerging. We are even far beyond Europe when it comes to normalizing and being back into GDP levels. In this context, we don't buy into this inflation, long-lasting inflation. Again, no big change in the I will say unbalance between saving and investment. No big change into the labor market. It's still a very big gig economy. Uberization is still there. Amazonification is still there in a way. So we don't buy into this long-lasting change in the labor market structure. So no big change as well to be expected in the oil prices. We don't expect a super 100% oil level. So in this context, the central banks are going to be very gently removing their accommodation. So this is a risk-on environment that we are describing within Natixis research with a bit of a skew in favor of Europe. We try it again this year. So maybe we have one question for Joe, if the connection is okay. Joe, I don't know if you can hear me. Joe, just a question regarding Jerome Powell's succession. Is there something cooking after Jerome Powell? Is it a risk from the replacement of Jerome Powell in your view?
Yes, very much so, Jean-François. In fact, I would say the probability that Powell gets replaced is slightly above 50-50. Normally, you wouldn't replace a Fed chair who you're happy with, but under President Trump, he broke that precedent, among many other things that were broken precedent. And to me, there's a very good chance that Powell is replaced. And who Powell will be replaced with will be somebody who is equally dovish, maybe even more dovish. So that'd be another outside risk to the aggressiveness and those that think the Fed might be moving rates sooner rather than later. Yes, I think Powell will probably get replaced. And his term, by the way, ends in February of 20.
Thank you, Joe. And if you had to take a guess on who could be the next Fed governor?
There's 3 people I would put front and center. It would not in any particular order, but Cecilia Roos, who is the current chair of the Council of Economic Advisors, Raphael Bostic, who is the Atlanta Fed president, and Lael Brainerd, who's currently a Fed governor. I would put those 3 as the likely candidates to replace Jay Powell.
Thank you, Joe. Maybe a question for you, Dirk. Dirk, one question. What could be the big surprise coming from the ECB strategic review? We mentioned average inflation. We mentioned a bit green transitioning. Could it be something very surprising from the ECB, Dirk?
I think that the main focus should be indeed on the new inflation target. And here again, I don't find it likely, and therefore it would be the biggest surprise for me if they were to move to average inflation targeting. I think that would be a significant change in the way the ECB operates. I wouldn't completely rule it out, but certainly would qualify as a surprise. Other than that, there's a lot of smaller things, and of course the greening, but that's not a surprise, will be important and will specifically taken into account in the statutes. But I guess the inflation target and what will happen there. That should be the main focus, and this is where the potential for surprise is probably the biggest.
Thank you, Dirk. I see we have no further question here from you. So thank you very much for joining us. So you can read the full paper has been released today, and you can have a look as well on the survey of what could be the risk, what are the consensus of Natixis clients going forward. We will have a new Outlook event in mid-November of this year to think about what is in 22. So we will be having this, I will say, a session to look back at what we just said to you clearly on this kind of Goldilocks environment. So you can follow us still on our research website. You can find everything from the research, not only macro and strategy, but as well lots of thematics on green infrastructure, mobility, real estate, you name it. So you can find that in research.natixis.com, and do not hesitate to follow us on the social media as well. We will be more than happy to answer any of your remarks or questions. Thank you very much for joining us, and see you and talk to you soon.